You ever look at a big company and just wonder what's really going on in there? Forget the flashy marketing and the slick CEO interviews. The real story, the actual truth, is written in a language that everyone in business gets, the language of financial statements. So today, we're going to learn how to read it. We're going to become business detectives.
So, how do you really know if a company is killing it or just, getting by? It's the ultimate question for anyone who's interested. And look, the answer isn't in some flashy headline. It's actually hidden in plain sight, inside a few key documents. I want you to think of yourself as a detective, right? And these documents, they're our evidence. They're how we're going to crack this case.
Okay, so here's our game plan. We'll kick things off with the big picture, then we'll zero in on three key pieces of evidence: the financial snapshot, the performance report, and how ownership changes. And then the best part, we're going to connect all the dots. So, how does all this work? Well, it's kind of like every business speaks the same secret language. It's this standard set of reports that lets us peek under the hood and see what's actually going on. And the cool part? It lets us compare different companies, apples to apples. Okay, so this is it. These are our main clues. See, according to the official rules, a company's financial story is told in three main chapters: the statement of financial position, the statement of profit or loss, and the statement of changes in equity. These are the big three we're going to be digging into. And this whole thing isn't just for giant for-profit companies. Nonprofits, even the public sector, they use a version of this too. Their goals are different, of course. They're not chasing profit, they're trying to deliver value or a service. But that need for transparency, that's the same everywhere. But for our investigation today, we're going to stick to the for-profit world. Okay, let's grab our first piece of evidence. It's called the Statement of Financial Position. You might have also heard it called the balance sheet. The best way to think about it is like a snapshot, a single photo, freezing the company at one specific moment in time. So, what's in this photo? It answers a really simple but super important question. On this one particular day, what does the company own and what does it owe? That's it. It's the bedrock of its financial health. So just to be super clear, this statement is our evidence list, but only for a single day. It lays out the company's assets, that's what it owns, its liabilities, which is just what it owes other people, and its equity, that's the owner's actual slice of the pie. Everything is totally frozen on one specific date, like, say, the last day of the year, December 31st. All right, let's break this down. First half of the puzzle, assets. Simply put, these are all the valuable things the company owns or controls. They get split into two buckets. You've got your non-current assets. These are the long-term things, like buildings, factories, heavy machinery. And then there are the current assets. These are the short-term things, stuff that's expected to turn into cash pretty quickly, within a year. Think inventory on the shelves or, actual cash in the bank. Okay, now for the other side of the coin. And here's the magic rule. This side has to perfectly balance with the assets. So what's over here? It's made up of two things. Equity, that's the owner's claim to all that stuff, and liabilities, which is what the company owes to everybody else. This is like the golden rule of accounting. Assets have to always equal equity plus liabilities. Everything has to add up perfectly, no exceptions. All right, time for clue number 2. Now, if the last statement was a photo, a snapshot, this next one, the statement of profit or loss, is the video. It's the highlight reel. It shows you all the action over a period of time, like a whole year. It tells the story of what actually happened. And this one answers the question everybody wants to know. After all was said and done, after all the selling and all the spending, did the company actually make any money? So, how do we figure that out? We look at the P&L, or the profit and loss statement. It basically sums up the company's performance by taking all the money that came in the door, that's revenue, and then subtracting all the costs and expenses of running the business. Whatever is left at the end, well, that's the story of whether they had a successful year or not so much. And it's a pretty cool journey, check it out. It always starts at the very top with revenue. That's the total amount of sales. Then you subtract the direct costs of making what you sold, and that gives you gross profit. From there, you start taking away all the other expenses, marketing, admin, rent, to get to your operating profit. And finally, after you pay the bank its interest and the government its taxes, you arrive at the most famous number in all of business, the bottom line, the profit for the year. Okay, on to our third and final clue. In this one is the missing link. It's the bridge that connects our snapshot photo with our performance video. It's called the Statement of Changes in Equity.
So the P&L told us if they made a profit. Great. But this statement answers the next logical question. So what? What did they do with that profit? Did they keep it? Did they give it away? How did it change the owner's stake in the company?
Yeah, the Statement of Changes in Equity, or SOCE for short, it does exactly what its name says. It tracks every little change to the owner's piece of the pie. It shows you how that profit we just found makes their stake bigger and how paying out cash to them, which we call dividends, makes it smaller. It's basically the story of the owner's investment over the year. And look at how it works. It's a really simple story. You start with what the owner's equity was at the beginning of the year. Then you add in the profit the company made, that number we found earlier, and you subtract any dividends they paid out. And boom, what's left is the brand new final equity balance at the end of the year. Simple as that. All right, detective, we've got all our clues. It's time for the big aha moment. Let's see how these pieces all snap together to tell one single cohesive story. We're going to use a real example here from a company called Picolet. This is it. This is where we crack the case. Okay, so here's how the magic works. It's just 3 simple steps. First, we grab that final profit number from our performance video. Second, that profit flows over and updates the owner's stake. And third, that new updated number slides right into our snapshot and poof, everything balances. Let's watch it happen.
Okay, step 1. Here's Picolet's statement of profit or loss. We're following this story all the way down from the top line revenue, we subtract all those costs, and we land right at the bottom line. And there it is, the key number. The grand finale of their year's performance is a profit of $352,000. Okay, remember that number, it's important. Step 2, so where does that $352,000 go? It flows directly into a really important part of equity called retained earnings. That's just a fancy name for all the profits the company has kept over the years instead of paying them out. So look here, you can see it in action. They started with $270,000, they add our $352,000 in profit, they paid out a little bit in dividends, $6,000, and they land on a new final number, $616,000. That's our key.
And now, for the final reveal, step 3. We go all the way back to our original snapshot, the statement of financial position. And would you look at that? Right there, under the equity section, is our new retained earnings figure of $616,000. And with that one number plugged in, everything else just falls perfectly into place. Total assets on one side, $1.169 million. Total equity and liabilities on the other side, $1.169 million. They match to the dollar. The books balance, the story makes sense. Case closed. So you see, in the end, these things aren't just a bunch of boring spreadsheets with random numbers. They're chapters in a story, a real story. That first snapshot, the statement of financial position, that's the setting. The P&L, the video, that's the plot. That's where all the action is. And the changes in equity, well, that's the character development. So now that you know how to read this language, the only question left is, what stories will you discover?